So, very good morning and thank you for joining us. So, today I'm talking to Carlos Montalvo, and we're going to be talking a bit about Solvency II, a little bit about the reforms, and looking ahead to the future of the industry. So, Carlos, thank you very much. Let me start by asking you which improvements you think have been the most crucial in the upcoming Solvency II reforms.
Conceptually, simplification, because the framework, first of all, good morning, apologies. But conceptually, for me, very clearly simplification as the model is way too complex. Now, this is easier said than done, and I'm not sure that we are basically achieving what we want in terms of simplifying the framework. So that could be the first one. The second element that I think is relevant and important is that in addition to simplification, there is an element of adaptation. You think Solvency II is a piece of 2016? Well, not exactly. Directive was adopted in 2009. And so many things have changed since then. The way we do insurance, the way we work on a day-to-day basis, technology, data, AI, so many things are changing. If we are not adapting the framework, we are going to end up into trouble. And the third point that I think is still relevant is, some would say with some caveats, but we remain under the assumption that this is a risk-based framework. In other words, there is a basis, an underlying basis that justifies changes. So I think those three elements for me are key. Now, there are other issues that could be seen as more controversial in terms of facilitating a certain type of agenda. I think also regulation should acknowledge reality. And today, if we are talking about productivity, competitiveness, and so on, it is only fair to reflect those, to make an alignment, not to work on silos. So not looking at Solvency to review outside completely things such as savings and investment union and so on, but also to do so not forgetting that when we started this process, and in my case it is 25 years ago, we always had in mind that the main objective here was to enhance the protection of policyholders, and as a secondary objective, the financial stability of the system. And that the mean to do so was by aligning the way we would regulate the business, risk-based, with the reality of the business, which is about risk. And I guess I spoke too much.
No, it's fine. Because I want to just ask about two specific areas, the ultimate forward rate and volatility adjustment. Will the new proposals solve the various issues that we've seen with those, make the framework more market consistent, or should they be abandoned altogether? What's your take on those specific areas?
My take on the long-term guarantee package is that it's the perfect reflection of the fact that perfection is an enemy of good. They are by no means perfect. Technically, and this is an actuarial magazine, there are a lot of question marks on how they have been designed. However, without those measures, we had gone direct into failure in terms of Solvency II. We had created a massive problem with regards particularly to life business. So they are not 100% bulletproof from a technical standpoint. They were not before. They remain not being. So the new methodology for UFR, for example, it is still, I would say, more generous than what reality tells us. We talk about deep liquid and transparent markets. And let's be honest, the EIOPA came with evidence that there are deeper markets at 30 years than what you would have at 10 or 20, particularly on euro currency. So there is not only, let's say, a technical dimension, there is also, let's say, another dimension which acknowledges the business. So if you ask me, also with the VA, it's very much the same type of approach. Is the review heading into the right direction? Well, the right direction is to keep these measures, to make, as I said before, something which is not perfect, but which is more aligned to reality. Now, for me, the question mark that probably you are missing, sorry for that, is the MA. I am strongly convinced that the MA is a much better instrument than the VA in terms of a proper ALM, in terms of discipline, in terms of risk management, and so on. And it comes with a list of conditions that need to be met. But when doing so, it should also allow and facilitate life insurers, for example, to come back and offer attractive guarantees at the right price. So looking at extrapolation on VA, sorry if I speak too long, but I'm sure that you as a journalist can then probably, let's say, streamline the whole thing.
Yeah.
But we need to look at them together with MA. And I think it's also been a lost opportunity to further enhance and push towards the use of MA for new products throughout the European market with the reform.
Well, you said at the beginning, of course, that simplification was very desirable. Now, Solvency II allows for internal capital models, which can differ significantly amongst insurance. And therefore, we see that most large European insurers are using very different, complex models for their capital. How do we manage this diversity and complexity? Should the industry move more towards harmonized internal capital models like the banking industry? How do we streamline that? How do we create a simpler and an effective model?
I would start by saying that, in my view, internal models make sense. We have a core principle on Solvency II, which is proportionality. But proportionality must be a two-way road. Make it easier for the smaller companies, but expect that a large company, a global player, should not be using a standard formula, but should elaborate an internal model. So a starting point, for me, models make sense. And if models are a bespoke type of suit, by definition, they should have differences among the different players, because there are also different bodies, right? At the same time, there has to be two elements which I think are important. One is comparability, and another one is soundness. Now, when it comes to comparability, and this is interesting, at my days at EIOPA, we were pushing, so the original text, that those companies that could be coming out with an internal model could also give information around the standard formula numbers to allow for an assessment of the difference and to understand where they were coming from. The message sent so much about proportionalities that would add another layer of complexity. But the underlying reality is that in order to justify the high expenditure that you are going to be making in order to develop an internal model, one of the reference points you have always is the standard formula numbers to see the difference and whether that makes sense. So this could be information available. Why actors that were going into the direction of internal models, and rightly so, decided not to disclose this whole information as a way to educate the market, which I think is particularly important, is something I don't have the response for. If you look at what has happened now with the review, again, EIOPA gave a second push on that. And at the end, what has come is a little bit of a compromise saying, well, it's not a full standard formula calculation, but an approximation. I wouldn't shy away of explaining what are the differences, because those has to do with the effective risk underlying, let's say, your own company and your own profile. So if you are able to educate the market around that, that would be business as usual. The other element is soundness. And I think that EIOPA has to play a bigger role in terms of ensuring that, let's say, even if with a different way to do it, but the same risk end up leading to similar or to the same type of calculations. So there is an important role. I'm not talking about EIOPA as a single supervisor or EIOPA basically being in charge of supervision of internal models, but ensuring a high level of consistency in terms of outcomes. So in terms of the what rather than in terms of the how.
Well, let's zoom out a bit and look at international developments in investments by insurers and private credits. Which global developments do you see as most important or promising from an investment perspective for insurance companies?
I think that the starting point is to understand where we come from. And where we come from was, let's say, an insurance sector that was heavily invested in sovereigns and corporates. Now, reality, inflation, and others show us or remind us that if we remain too prudent on the asset side, it's going to be very difficult that we end up offering, let's say, appropriate and attractive products to policyholders. So there has to be a different type of blend. Now, a different type of blend, and that's one of the beauties of Solvency II on the so-called prudent person principle, is that that means that more risk should lead to more capital, right? Well, but it is fine. You make your call, you decide that it makes sense for you, for your product offering, for your policyholders, for your shareholders, and you go for it. Now, what is important is to ensure that you understand what is the new product in which you are entering, You may be talking about defense expenditure, which is trendy. You may be talking about private credit. You may be talking about infrastructure. And do so always under the assumption that what you need to understand, whether this is the right product for your company and whether it is rightly priced, also from the point of view of how not only credit risk, but also liquidity risk are, let's say, through the spread, well, delivering a return for you. What doesn't make sense is to pretend that insurers as institutional investors end up investing in assets where the cost of opportunity is suboptimal. In other words, where the return they're getting for the risk they are taking doesn't make sense. So I mentioned prudent Platon principle, and I think this is important because what we also need to avoid is a little bit of a heading element of, oh, now everybody's talking about private credit. I don't have the capacity. I don't understand. I outsource, but I don't know what is coming. If you don't know what is coming, how are you going to be able to make the assessment between the risk and the spread? If you are able how to do it, so be it.
Let's look a bit now at international developments in reinsurance. And I'd be interested to know what you see as the most important or promising for the reinsurance market. And are there particular impacts that we should be thinking about, like, for example, climate change on the future of reinsurance markets?
When it comes to reinsurance, the good news is that we have a soft market now in the sense of capacity and offering. It seems that reinsurers are there and they are taking most of the risk that is there in the market. And that is good news. The bad news is that we come from a hard market and that in the future, we will also be confronted with that. So what we need is to make sure, particularly for these traditional risks that are more exposed, climate risk, nat cat risk, etc., that we are already anticipating today the thinking in terms of what if we go back more often than before to this type of hard markets, what are the solutions, what are the alternatives? That's the first thing. And the second thing is we are also seeing, let's say, a non-traditional type of reinsurance, which is a way in which capital is also coming to the market. Again, let us make sure that there is an effective risk transfer. And yes, it can be done. And yes, we have seen that, for example, with the heavily debated mass lapse type of reinsurance, where with some adjustment, you could be able basically to serve two masters in terms of risk transfer and in terms of capital flowing into the market and capital benefits. So it's even three masters rather than two masters. That is also an important element. Don't forget one thing. We need to evolve. We need to be proactive, but we also need to avoid being complacent. If we have a soft market, and I'm coming back to the traditional reinsurance today, that doesn't mean that we are out of the challenges that may come ahead, particularly, as you rightly say, in terms of climate risk, nat cat related ones, where frequency and intensity are increasing. And if we do nothing, we are going to end up confronted with a problem. By the way, and this is a side comment that it's probably not for the interview because one doesn't talk about what they do pro bono. I'm doing a pro bono piece of work for the Insurance Development Forum in terms of basically availability of, and accessibility and affordability of insurance, so insurability, long story short, and the role of regulation. And I think it's interesting. I'm coming with some new ideas, both in terms of capital recognition of Build Back Better initiatives and in terms of using mechanisms. For example, in the US, you have something called Fortified, which is kind of an ISO type of methodology in terms of building resilience and so on, that in some states where regulators, as you know, in the US, have the right to set the prices. Mm-hmm. So if companies or houses, are meeting these standards, the regulator impose a lower price to the company only because the risk is lower. Now, if we extrapolate this type of metrics to say a lower capital requirement, similar to how we treat bonds, right? Yeah. You have two factors, which would be basically rating and duration. Here you have two factors. One is instead of rating, you could say location of where the risk is placed. So it's not the same being by a river that is exposed to flood than being somewhere else. And a second one is if you meet some ISO, Fortified, or kind of standardized type of benchmark requirements, that you would be able to benefit from a capital requirement to a reduction similar to what we do with a triple A versus a single B, for example. But that's a side comment that has nothing to do with the interview, but it's something I'm quite happy with in terms of trying to come with new ideas, to problems that we will be confronted with.
Well, let's stay with reinsurance, because I have a question here on asset intensive reinsurance and how this is a complex structure. But tell us a bit how these products work. Is it a good development? What are the risks and opportunities? And are there, from your perspective, any supervisory concerns?
There are supervisory concerns. I think last week only or 2 weeks ago, there was much noted speech by PRA, which raised the flag on some issues that in their view may be relevant. And I think it was by Vicky White, if I'm not mistaken. There are ongoing discussions at EIOPA level, similar to the ones that we had with Mass Labs, in terms of asset-intensive reinsurance. A couple of messages, in my view, around that. I mean, we talked about innovation. We need more capital, particularly if we want insurers to play a bigger role in terms of pension transfer. And I remain convinced that pension risk, I'm talking market risk, I'm talking longevity risk, are better placed in insurance companies as compared to non-financial corporates. And in order for insurers to be able to absorb these risks, it is important that there is more capital flow. Now, similarly to what we have seen with the Mass Labs, there are elements that remain high in the agenda of supervisors in terms of concerns, whether we are, for example, basically swapping market risk through a spread versus counterparty default risk. Another side comment, so not for publication, market risk is overcalibrated, counterparty is undercalibrated under Solvency II. So it's also the fault of those like myself that design the model. And obviously, when you have something which is overcalibrated and something that is undercalibrated, you try to navigate and move from one to the other. As I said, that's a side comment. That's not for publication, okay? But at the end, I think that the question is, can we come with an asset-intensive reinsurance model that allows capital to flow, insurers to take this risk moving forward, and regulators not being that concerned in the sense that we may create moving forward, particularly if this grows significantly a potential systemic risk? I think the response is a clear yes.
Just the last couple of quick questions then. I think we have about enough time on the Zoom. I wanted to ask about, take the example of Bermuda, which represents about 35% of the world's reinsurance capacity, declared an equivalent jurisdiction under Solvency II. But it turns out that there is supervisory resistance despite this equivalence. And I know EIOPA has launched this public consultation. So the question really is the European supervision too strict or too lenient on third country insurers?
That's a very interesting question. If you think on the Bermuda example you were asking about, yes, they were granted equivalence back in 2015, 2016. Yeah. But interestingly enough, they have embarked themselves in a number of reforms of the model to retain that equivalence. And I would say that they have succeeded on that. Why? Among other things, let's go back to the example of reinsurance, which is probably the elephant in the room, because one of the measures that they have decided to take is that prior to granting the approval of a reinsurance transaction, like the ones that we have been talking about, they consult the host supervisor, so the regulator of the ceding insurer. And if the regulator poses an obstacle, they will decline basically the transaction, which is an interesting one. There were some issues around the potential arbitrage that you may have around the SBA, which is something similar to the matching adjustment. And there was an element of that. Well, there has also been changes around it. So that's the first part. The second part is that, let's be honest, is that we all tend to be local because we think that if things go wrong, localism is going to protect us better than globalization and internationalization. Is that something which is kind of 100% true or bulletproof? I think it's not about whites or blacks, it's about grays. Globalization also helps because it brings diversification and others. But let's be honest, and I have been a regulator for nearly 20 years, one feels more comfortable when the assets are here as compared as the assets being far away. That is reality, and there is nothing, has nothing to do with regulation, with supervision, that can change that.
Finally, then, the Dutch central bank president Klaas Knot has stated that the global economic circumstances are more uncertain than ever. I think we know that. Have we learned sufficiently from the past to avoid a new financial crisis? And with your view from your career, which developments or best practices are important for Dutch insurers, or what are the messages for the future that we should be aware of?
This is interesting, and I read another letter last week from a EIOPA chairperson that was basically looking at some of the changes on the delegated regulation of Solvency II. So those are not yet concluded, and was saying that to a certain point, this could be basically like removing the speed limits at the same time that we would be removing or increasing the speed limits at the same time that we would be removing the obligation to have airbags in the cars. Where this comes from, because you talk about my past experience, leads me back to 2008, 2009, where I was the Secretary General of SEIOPS, the Committee of European Supervisors, and we had a big crisis. We had a big crisis that one of the reasons that it came with had to do with a strong deregulation trend that started in the US and then moved into Europe. Now, when that happened, let's be honest, those that were named and shamed were regulators. So if you could be a regulator today, what could you be doing? Well, you could at least be sending a word of caution, which is what regulators are doing worldwide. Could it be Klaas Knot? Could it be EIOPA? It doesn't matter. And I think they are right in doing so, because we have had crises in the past and we will have crises in the future, among other things, and this is important, because Solvency II is not designed as a zero failure regime. That would be uneconomical. So if this is not zero failure, that means that we should prepare for potential failure.
Well, thank you very much. I think that's a good place to leave it. I'm going